I'm going to show you the stock market strategies that actually build generational wealth, not the get-rich-quick garbage you see everywhere else. The secret isn't a complex algorithm or insider trading. It's 5 fundamental frameworks few retail investors ever truly master. If you miss just one, you lose. Forget the noise and the meme stocks. We start with the single most important decision: defining your investor mindset and risk profile. The first step is establishing your investment policy statement, or IPS. This is your commitment document outlining goals, liquidity needs, and time horizon. Risk is not volatility. Risk is the permanent impairment or loss of capital. Your portfolio structure must prevent this permanent loss. Ask yourself, if your portfolio drops 30% tomorrow, will you sell in panic or buy more? Your answer determines your optimal allocation. A 25-year-old maximizing growth might choose an 80-20 stock-to-bond ratio, while a retiree protecting principal might opt for 40-60. This framework separates speculators who gamble on short-term price movements from investors who buy ownership in profitable enterprises. Now, let's move to the 2 foundational pillars: value investing, favored by billionaires, and growth investing, favored by disruptors. Value investing, championed by Benjamin Graham and Warren Buffett, means finding companies trading below their intrinsic. The goal is simple: buy a dollar for 50 cents. You achieve this by analyzing hard assets, stable earnings, and low debt. The critical concept here is the margin of safety, MOS. This is the cushion between the stock price and your calculated intrinsic worth. To calculate intrinsic value, investors often use the discounted cash flow, DCF, model, projecting future cash flows and discounting them back to today's value. You screen for low price-to-earnings, PE ratios compared to industry peers, ensuring the company isn't just cheap, but undervalued. But beware the value trap, where a low PE means the market knows the company or industry is structurally dying. Modern value investing focuses on durability. Buffett taught us to look for the economic mode, a sustainable competitive advantage. This mode could be high switching costs, network effects, or intangible assets like brand loyalty. Think Coca-Cola or Apple ecosystem. Value investing demands patience. You're waiting for the market to realize the true worth of the asset, which can take years. This leads us to the opposite philosophy, growth investing, which focuses on future potential regardless of current valuation metrics. Growth investors seek companies disrupting old industries, pioneering new technologies, and generating accelerating revenue expansion. The focus shifts from low PE ratios to high revenue growth, typically 20% year-over-year or more, and massive total addressable markets, TAM. Since earnings might be negative as they reinvest, the price-to-sales, PS, ratio often becomes the preferred valuation tool. Investing in early-stage growth means betting heavily on visionary leadership and the execution capabilities of the management team. You're looking for companies with high gross margins, indicating product strength, even if operating margins are currently low due to R&D spend. A key framework is Peter Lynch's GARP, or growth at a reasonable price. This attempts to blend the safety of value with the power of growth. However, growth stocks are highly sensitive to rising interest rates, as their expected future cash flows are discounted more severely. The main risk here is the hype cycle, when market sentiment outpaces reality, leading to unsustainable valuations and sharp corrections. You must define clear exit parameters. Does revenue growth decelerate? Did the CEO leave? These signals mandate a portfolio review. The successful implementation of either value or growth is entirely dependent on your commitment to the long haul, years, not quarters. But maybe you prefer action. If you want to capitalize on short-term movements, you need technical analysis and trading discipline. Technical analysis assumes all fundamental data is already priced in and focuses solely on reading the market sentiment through price action and volume. Key tools include moving averages, typically the 50-day and 200-day, used to define the short and long-term trend direction. The golden cross, where the 50-day crosses above the 200-day, is a powerful bullish signal often preceding major upward trends. We also use indicators like the Relative Strength Index, RSI, to gauge if a stock is overbought above 70 or oversold below 30. Volume confirmation is vital. A price breakout without high trading volume is usually unreliable. It's a fake out, not a trend. But technical trading is useless without brutal risk management. Your first trade rule must be capital preservation. Never risk more than 1% to 2% of your total trading capital on a single position, regardless of how confident you feel. Stop-loss orders are non-negotiable insurance policies. Set them immediately to cap your downside before emotional decisions take over. Position sizing must be based on volatility, using metrics like average true range, ATR, to adjust share count, ensuring consistent risk exposure. The brutal truth is that 90% of active traders fail not because of poor analysis, but because they violate their own rules under pressure. Swing trading offers a middle ground, holding positions for days or weeks to capture market swings, utilizing daily charts over minute charts. These three strategies, value, growth, and technical, are tools. But every great craftsman needs a toolbox, not just a single wrench. This brings us to strategy 4, portfolio management, the framework that binds your individual trades into a cohesive, resilient unit. Diversification is often called the only free lunch in investing. It smooths returns by ensuring losses in one area are offset elsewhere. True diversification extends beyond sector choice. It includes asset classes, stocks, bonds, real estate, and hard commodities like gold. You must ensure your assets have low correlation. When stocks crash, quality bonds often rise, providing the crucial ballast you need. Geographic diversification protects you from localized economic shocks. Do not let 100% of your capital rely on one nation's policies. Avoid overconcentration. If one stock grows to more than 10% of your portfolio, you're taking an unacceptable company-specific risk. The discipline of rebalancing is essential. If stocks outperform, you mechanically sell some gainers and buy more underperforming assets. Rebalancing forces you to adhere to the core mantra: buy low and sell high, preventing emotion from driving your allocation decisions. Some investors utilize tactical asset allocation, TAA, slightly adjusting portfolio weights based on prevailing macroeconomic views. For example, anticipating recession, you might tactically underweight cyclicals and overweight defensive consumer staples and treasury bonds. All four strategies, mindset, value, growth, and portfolio structure, must culminate in strategy 5, the power of compounding. Albert Einstein allegedly called compounding interest the eighth wonder of the world. It's the engine of all real, long-term wealth creation. The magic of compounding means your earnings generate their own earnings, exponentially accelerating your capital base over decades. Time is your greatest asset. Starting early with even small amounts outweighs waiting and investing large sums later. Use the rule of 72. Divide 72 by your expected annual return to estimate how many years it will take to double your money. This rule reinforces that consistency and maintaining reasonable long-term returns, e.g., 7 to 10%, is far more important than chasing 100% wins. Consistency also means regular contributions, known as dollar cost averaging. This mitigates the risk of buying at market peaks. Now, let's quickly tie these threads together with practical examples you can act on immediately. If you're a young investor, blend growth and value by allocating 50% to high-quality large-cap tech and 30% to stable infrastructure assets. The remaining 20% should be reserved for counter-cyclical assets like gold, bonds, or high-yield savings to absorb market shocks. If you're approaching retirement, prioritize income and stability. Focus on dividend growth stocks and high-grade corporate bonds. If you dabble in active trading, commit to tracking your results meticulously. Analyze every single deviation from your IPS and stop-loss rules. Remember, the biggest mistake is not choosing the wrong stock, but having no defined strategy at all. Review your IPS annually. Life changes, and your financial goals must adapt. This isn't a set-it-and-forget-it plan, but a dynamic system. Embrace the concept of productive failure. Mistakes are expensive tuition if you learn from them, but disastrous if you ignore the lessons. Ultimately, wealth is built when disciplined strategy meets the exponential power of compounding time. Don't just watch this video. Choose one of these 5 frameworks and apply it to your portfolio this week. Commit to starting today. Procrastination is the silent killer of compounding returns. If you found this detailed breakdown valuable, hit the like button. It supports the channel and signals that you want more deep dive strategy sessions. Which strategy resonates most with your personality? The long, methodical haul of value or the high-speed potential of growth? Let me know in the comments below and share your biggest portfolio mistake so we can all learn from it. Subscribe for weekly content that cuts through the noise and delivers actionable financial intelligence for serious investors. Until next time, control your risk, trust your strategy, and let time do the heavy lifting. Your investment plan must be a rigid document, reviewed regularly but changed rarely. Don't let quarterly headlines derail a strategy designed to work over decades. So, which of the three strategies should you choose? Value, growth, or dividend? For young investors with high risk tolerance and a 40-year horizon, a majority allocation to growth is sensible. If you're mid-career with moderate risk and want steady performance, combine value and growth. A 50-50 approach using core index funds in both categories offers robust diversification. For those nearing retirement, shifting heavily into high-quality dividend stocks and bonds provides necessary income and stability. No matter your choice, remember that compounding interest is the eighth wonder of the world. Start small, stay consistent, and let time do the heavy lifting for your portfolio. The secret to investment success isn't complexity. It's consistency and the relentless avoidance of panic. Let's review the technical details of the value strategy for a quick recap. You are a detective searching for mispriced assets the masses have overlooked. Now, the key metrics for growth: high EPS growth, low PEG ratio, and often zero dividends. Your focus is on market domination and the massive scaling potential of new technology. And finally, dividend investing: yield, sustainable payout ratio, and the consistency of payment history. This is your path to financial independence and crossing the retirement finish line with reliable income. Remember the importance of technical tactics like DCA and rebalancing to keep emotion out of the process. They automate discipline, ensuring you buy low and sell high automatically over decades. Ignore the noise, stick to your written plan, and let the power of long-term compounding work its magic. I'm challenging you right now. Take 5 minutes after this video to define your risk profile and time horizon. That is the first crucial step toward mastering the market and building generational wealth. Which strategy resonates most with you? Value, growth, or income? Drop your chosen strategy in the comments below, and let's discuss why it aligns with your life goals. If you found this deep dive valuable, hit the like button and subscribe for more high-level finance breakdowns. Your future portfolio is waiting. Don't waste another day making emotional mistakes.